So every time we're helping clients with wealth creation, whether it's buying properties or shares or portfolios, firstly, we always start with a plan. So the plan always has, where am I now? What am I targeting? What's my goals? And then we look at strategy. And part of that strategy is not only what investment to buy. So yes, we might be going to be buying a property, but how do we structure it? Is it positively geared? Is it negatively geared? But also, who should own it? So, and this is the structuring. So we can own that property. Let's say we've got a medical professional who's earning $800,000 and their spouse is not working. Now, this isn't always the case. We often find specialists are married to other specialists, so they're both earning. But let's say we've got one high-income earner and one who's been who's chosen to be the primary caregiver and run the family. So in this case, we've got a tax problem with the high earner. So it's tempting to put all the negative geared properties in their name so that they get a tax deduction. And there's some merit in that. But what we do is we create another tax problem down the road where when they eventually have to sell, if they have to sell those properties, we've now only got one owner, so they have to pay all the capital gains tax, so they can't spread the capital gains tax. So sometimes we'll use structures, and you need to get really good advice from people that are doing this stuff all the time. Structures where we'll introduce, say, a family trust, and they'll do their gearing in the family trust. But we've got to make sure if that's negative inside the trust, they can't claim those losses personally. So sometimes we'll do the borrowing in the name of the high income earner, and we're trying to get a balance of where we can have our cake and eat it too. It's impossible to do perfectly, but I'll just give you an example. Let's say, and I'll do the two contrasts here. So contrast one, we're just chasing a tax effective asset. So you might err in having it in that person's name, but the problem is too, if they're a medical specialist, they don't want assets in their own name for asset protection reasons. So you've really got to use an entity. So yeah, then you're working out whether they're lending money into another vehicle. So they pick up the deductions. They might be lending money into a trust, whether that's a unit trust or a discretionary trust. Once again, really good advice there. So they pick up the deductions, but not the income. Or whether you've got strategies where any income they're making on these things is going into another vehicle, or a cash flow strategy. So let's say they're just making really good money and they're building up cash. Instead of chasing the tax returns, we're investing in a structure where we can stream the income to the low income partner, and they're not paying much tax on the first 20, 30, 50,000 of investment earnings. So if they buy a property cash, and we've got clients that are using cash flow to buy property rather than debt because the businesses are making really good money. So they can have that stream completely to that other partner for say up to 100 grand, with only paying 20 grand or so in tax. And then they can use an investment company to stream anything above that. So we've got to decide where the priorities are, tax, which always sets up a problem for later usually, or in just wealth creation. And there's often a combination of the two.